I think if you just take my previous comment, is that it's really in the small and mid cap space, and in a US context, they're micro cap, and so I think there's interesting opportunities in that space. There will always be the odd opportunity in the larger cap space whereby the market will overreact to a negative announcement. And so they will throw up, but they're more what you would call an opportunistic value opportunity rather than what we're what we're working towards and trying to seek out on a daily basis. So if I may just give you an example of a company, our largest position in the fund is a holding company in Australia called Veals. Veals is a company that's been listed since 1951. So it's actually quite an old company, listed by a gentleman, a very famous stockbroker called Sir Ian Potter. If anyone's interested, and there is a biography on him, and it's quite fascinating and gives a good history of Australia. But this company started off as a family company selling electrical appliances across Australia, and the business evolved, and they sold that business off, and they looked to reinvest, and they reinvested into farmland in Australia in the 1980s, and so Australian farmland has actually been one of the best performing asset classes, as has New Zealand farmland, over long periods of time. And so they did well out of that. In the 1990s, they decided to drive New Zealand and have a look around, and believe it or not, they purchased a ski field. And so if I come back to Veals, it's a really interesting company. Today, Veals has a $60 million market cap approximately. It has $45 million in cash sitting on its balance sheet. It has a forest, a French oak forest in France, 550 hectares. They're one of the largest owners of French oak in France. It has a farm in New South Wales that actually has green grass on it, so it's got rainfall. And if we say just conservatively, those assets are worth $15 million. So you have this pile of cash, some assets in France and Australia worth the market cap, and you get a ski field in New Zealand that they purchased in 1990, and everyone might shrug their shoulders and say, why are you getting excited about a ski field? But this is a ski field that caters just to beginners and intermediates, and its margins are phenomenal. And the ski field generates a net profit before tax of Australian plus $4 million, $4 to $5 million a year. So it actually has an intrinsic value. And so if you look at that stock today, it has a net tangible assets of close to $11 a share, and that's probably a conservative appraisal. And and our cost price is probably below $5 a share, and the stock price is somewhere around $6.75 today. So the Veals family owns 87.5% of the company. There is absolutely no reason for this company to be listed, and no surprise, we've waited patiently for a number of years. We're the only person that turns up to the AGM, other than the family, in Melbourne every year, and we've started to write to them and talk to them about the potential to either return capital to all shareholders or buy out the minorities. And these processes take time, but they have been very, very good stewards of capital. They don't pay themselves egregiously. They don't do any of the things that these family-controlled enterprises can fall victim to. So we feel like that stock offers us a significant margin of safety. In a number of circumstances, you could be in a significantly worse position with 87% control in a family who basically pay themselves egregiously and minority shareholders suffer. This is not the case with this one.